Hi there. So it's Marc von Grundherr again. Thank you so much for everybody for joining us today. I'm really pleased to be here with Richard Donnell from Zoopla, who is an executive director of Zoopla. And as I said, my name is Marc von Grundherr. I'm a director of Benham and Reeves. I'm based in London, and I run our lettings and our sales business. And we are here to do ideally to do a post-budget chat, and then Richard's gonna do a really in-depth update on the London market and predictions of how it's done and where it's going for investors and for rentals as well, so that we get a good understanding from a data perspective. But with so little in the budget, I'm not sure there's going to be that much to talk about, but Richard will go through that. So just to quickly introduce Richard. So Richard Donnell, he's the director of Zoopla. He's a leading property industry figure. He's best known for delivering insightful and strategic advice on the residential and mortgage markets. He's also got a deep understanding of how technology and data can unlock insight and business value across the residential and mortgage life cycle. Richard runs Zoopla's thought leadership, leveraging Zoopla's unique data assets and consumer insights to provide market-leading insight for industry leaders across investment, development, and mortgage lending, and of course, investors like all of you who've joined us today. So I'm going to step back because you don't want to hear me anymore, and Richard's going to do talking. By all means, please put your questions into the chat. We've had an unbelievable number of questions before we started. I hope Richard's going to close off a lot of those questions, but if you don't, as I said, feel free to put them in. We will try to answer them. So Richard's going to start, and then we'll come back and do Q&A after. So thank you very much. Over to you, Richard. Thank you.
Thanks very much, Marc. And look, thanks very much for getting me along to take part in today's webinar. As you say, not a huge amount to say on the budget, which thankfully didn't have a lot of change in terms of the housing market, because the housing market certainly has been subject to quite a lot of tax and regulatory change impacting housing over the last few years. I think the good news about the budget, it was all about focused on inward investment, getting jobs into London. And I'm going to run through some slides that give us, as Marc said, an analytical view of the housing market, and then we can open that up to questions and discussion. So the next slide, please. I think the first place we need to start is to really think about what drives the London housing market, because what drives the London housing market ultimately drives demand for housing, both rental and in the sales market. And this chart here is one that appeared on, it appears everywhere, but it's just lifted from the BBC. But basically it shows that London's all about people in their 20s moving into London for work and to study. And it's people in their 30s and 40s who tend to be, more mid-stage in their career, starting to have children. And you can see there's red lines there of people leaving with kids, people and older parents leaving with kids, and then a group of people there leaving London to study. So London's sort of demand for housing is really about the strength of London's economy, how many people are migrating to the UK, and just how many jobs the London housing market is creating, because that ultimately drives the demand for housing. And so if we can click 3 more times, please. I think the key things to note about London's economy is, and obviously London's been at the sort of heart of some of the challenges from the pandemic. We've got the same number of jobs at the moment in London as we had at the start of the pandemic. Working from home, some businesses relocating in response to the Brexit vote, and some banks changing their strategies for investment. And that's had a slight impact on slower immigration into London since 2016, but now that's really started to take off. Last year, the UK had the highest level of net in-migration to the UK. So that's 500,000 people came into the UK net, from people moving in to people moving out. A lot of that was students. The government relaxed the visa rules for students. There's also now being relaxations for visa rules to attract postgraduates and their families to come to the UK. So there's a real race for talent to come to the UK, to study, to set up jobs. And that's really important to get that inward investment. And I think that's why the budget yesterday was important, because it's all about driving employment growth, making the UK an attractive place to invest. And within all of this, For everyone that moves to the UK, half of those people historically have always landed in London and the southeast of England. And so that's really important from a sort of driving demand for housing perspective. So on to the next slide, please. Now this starts to feed through into the rental market. So Zoopla is a very large property platform, over 70 million visitors coming to the site every month, looking for properties to rent and to buy. And what we've created here is a demand index for lettings across London. And it's a rolling 7-day, and it looks at inner and outer London in particular. And I think the key point here is just how much the demand for rented housing has increased since the economy reopened and since borders have reopened, particularly from students and people looking for work, both domestic and other. So the purple line there is inner London. So that's the sort of central London part of the zones 1, 2, and 3 effectively in London, a little bit of 4 as well. And then outer London is the sort of lower rise, more suburban areas in sort of outer London. And you can see there that, you know, in 2021, so if we go back a slide, you can see there that, you know, that purple line shooting further, you know, right up to sort of, you know, demand being 2 times the 5-year average. You know, renters that came back when the pandemic was sort of over and offices started to reopen from spring 21, you know, renters focused on inner London areas. And actually the reason they went into inner London was because rents fell 10 to 12% over the pandemic. And so inner London was a great value for money for renters. And so a lot of renters moved to inner London. And then last year we saw inner and outer London do really well. And again, that's about the in-migration coming in, students returning, borders reopening, the economy really starting to open. And now what we've seen in the start of 2023 is because rents have gone up so much, as I'll talk to you about in a minute, we're starting to see renters look into outer London, looking for better value for money, just because rents in inner London have grown quite significantly. Just in a minute, inner London rents have grown 30–35% since 2021 because of all this demand. And the reason rents have increased quickly is, if I haven't put the chart in here, but if I did you a chart of the available number of homes for rent in London, it's around about 50% lower today than it has been over the long run. So there's been a real lack of new investment coming into rented homes in London. We just haven't seen the sort of strength of new investment that we saw up until those tax changes in 2016. And so when you have 50% lower supply and availability of homes to rent, and you see demand up by sort of 150% higher than the long run average, that's when you get rents rising very quickly. And if we move to the next slide, we can see the Zoopla rental index for new lettings. So we are comparing 2 indices here for year-on-year growth in rents. Number 1 is in purple, the Zoopla one, which is looking at new lets. So this, if I was looking at renting a 2-bed empty vacant flat in Canary Wharf a year ago, and I was looking to rent a vacant empty flat in Canary Wharf today, our index tracks how much rents have changed for properties that are becoming vacant. And about sort of 1 in 5 homes for rent become vacant a year. The average renter stays in their home 4 or 5 years at the moment. There's another index as well, which is run by the Office for National Statistics, which is the purple line on the left-hand chart. And that's looking at what's happening to rents across all rented homes in London, basically. And it's less volatile because we're looking at all rented homes in the purple line, whereas the orange line, sorry, whereas the purple line is looking at new lets. And you can just see 2 things really from the chart on the left. One, how much rents in London fell over the pandemic because we had working from home, we didn't have huge amounts of tourism and in-migration, then that rebounded, and so rents have recovered. Growth is starting to slow now. And again, if you owned a portfolio of properties in London, you're more likely to see your rents across your whole portfolio rising in line with the ONS index. Now, clearly, London's a very diverse market, which is why we should focus as a snapshot on the chart on the right-hand side. So this is looking at all the London boroughs. Each of these dots is a London borough. On the horizontal axis, we've got the average rent per month for those London boroughs. So, you know, out in Kensington, Chelsea there, and Westminster, you know, average rents for a typical property are over £3,000 per month. If you go to Havering and right out in outer London, you've still got rents at £1,600, £1,700 per month. The most important thing to look at here, just in this one axis, is the vertical axis, which is just how much of rent's grown since the economy really started to reopen from June 21. And you can see it's in those most expensive areas where all the city workers are based around the city. Westminster, Kensington, Chelsea, Tower Hamlets is Canary Wharf, Newham is out towards Stratford. And, you can really see rents have gone up by 35 to 45% in the last couple of years as demand has gone to as central a location as possible. But I think we're now starting to see demand move outwards a little bit into these more affordable but still accessible areas in outer London as renters look for better value for money. And so I think overall, we think rental growth is going to slow to 4 to 6%. It could be that rental growth in those most inner areas slows even faster, just to reflect the fact that rents have gone up so much. And so it's key. We see the economy continue to grow, migration continuing. That will support rental growth. But I think over the long run, we should all expect rents just to track earnings. And so 4 to 5% year-on-year growth in rents is perfectly acceptable. But we're going to see a few short-term changes in where that growth is going to come in London. So that's the sales market, the lettings market, short on supply, very strong demand. And again, that demand will be supported if we see the economy growing, jobs being created. And again, that's what the budget designed to try and do. The next slide is then looking at the sales market, because investors making decisions about buying property do want to think about capital growth. People are conscious about some of the big forecasts made last year by many people. Even yesterday, the Office for Budget Responsibility thinking UK house prices might still fall. I think that's unlikely, but we need to talk about what's the outlook for capital growth, and particularly what's the outlook for capital growth in London, and particularly inner London, because I do think there's an opportunity there. And so if we just want to put London in a macro context here, the outlook for house price growth and the capital values for investors is all about affordability, because homeowners typically drive house prices. In certain areas with a lot of investors, investors might be up to 20% of all buyers in some areas, but investors selling a property to a homeowner is what matters here. I think there's two things. So the chart or the map on the left-hand side is just what's the average income the typical UK household needs to be on to buy an average price home, not an investor, just an average homeowner buying a property with a 75% loan to value mortgage, and assuming they take a mortgage that's 4.5 times their income. And so you can see there in the south of England, London and its sort of hinterland, the income to buy is sort of typically over £60,000. That could be two people earning £30,000. But high house price growth in London has meant that it's slightly more unaffordable to buy in London, the southeast, and this has really had an impact on house price growth in London, the southeast, for the last 3 or 4 years, where house price growth has underperformed. If you look at the chart on the right-hand side, that's annual house price growth up until January this year, according to the Zoopla House Price Index. And you can see, those affordability pressures have just meant that house prices have not raced away as fast as they have in other areas of the UK, where housing is a lot more affordable in those green areas, basically. But I think this underperformance in London has not just been 1 year. As you'll see in a minute, we've had this underperformance for some time now. And as the economy reopens, there's definitely an opportunity in parts of inner London for buyers and investors. Next slide, please. And so when we look at house prices across the whole of London, so this chart here just shows what's the average value of a house across all the big postcode areas of London over the long run. What's then the average price of a flat or a maisonette over the same period? You can see that the search for space, people prioritizing space, which is a real feature of the pandemic, has continued to see the average price of a house increase. Whereas a key feature of the London housing market is the average value of a flat has really not really increased since 2016. And this is in nominal terms. And again, I think this underperformance of flats is probably going to start to reverse now, because I think flats in inner London in particular are starting to look better value for money compared to houses in London or houses in outer London. people looking to buy are thinking, well, do I move into outer London or do I move beyond because I've got more flexibility from working from home? And so I think these dynamics are starting to shape how people are thinking about apartments in London. The next chart has got these sort of a quick snapshot of one way of thinking about overseas investors. So this is, we run an index for central London. This is the top 10% of the market by value. It's not prime, it's just all properties in the sort of areas that account for the top 5% of the market by value. And that's the purple line there. So that's in local currency, sterling terms. It's similar to the chart on the left-hand side, which is for the whole of London for flats. I mean, most of inner London is apartments. And obviously there's some super prime houses, etc. in this area. But if we would just look at buying, what would I need to spend in dollars to buy that property? It basically shows that the weakness of sterling has made central London property values look about the same price to a dollar-backed buyer as they were, 10 years ago almost, in June 2013. Now, the weakness of the sort of limited weakness of the dollar in the last few weeks has seen that number bounce back up. But I think this change is likely to be getting some dollar-backed buyers, again, looking at the value for money plays and considering that as part of their investment strategy for buying property in London. If we go to the next slide, I think we then need to take a sort of the UK view on this. Have we skipped a slide there? No, probably not. Let's stick with the slide. Similar to the flats line that we showed earlier. Yeah, that's right. On to the next slide, please. If we think of the chart we looked at for the 5 years worth of rental demand, this is the same chart for the demand in the sales market. And, and this is looking at the commuter areas. So London drives out in the commuter areas, out towards Chelmsford, to the east of London, up towards Cambridge and Watford, out towards Uxbridge and Reading, to the west, down into Kent, and the commuter areas there. And you can see the impact over the pandemic, stamp duty holidays really driving very high levels of demand over 2020, 21, 22. And then over the back end of last year, we had higher mortgage rates going from an average of 2% to 6%. And that led to a big drop off in demand. But that demand has rebounded, and demand and activity in the sales market has rebounded to pre-pandemic levels, basically. It's not sort of really still ultra low. It's back to pre-pandemic levels. And if we click on to outer London, it's a similar pattern. There's a real correlation. So outer London, commuter London are very much houses-driven markets. And if we click on to inner London, you can see here that inner London performs slightly differently. Inner London is more international, as well as higher net worth British buyers. And you can see that inner London is seeing demand rebounded back better than outer London and commuter London, because that's where a lot of the focus has been over the pandemic. And you can see we're sort of back to the long run average. And again, this is signaling to us that activity levels in inner London, people are starting to recognise there's better value for money, the economy reopening, not just overseas buyers, not just British investors, but also first time buyers and people returning to the city for work. And again, if we drill that down into inner London and really looked at the true which bits of inner London, places like Kensington, Chelsea, and Westminster are actually slightly above 100, which is the long run average here. So we're starting to see evidence. We're not going to see a huge boom, but the good news is activity levels are picking up. Next slide, please. And if we look at this through the lens of a sort of UK buyer, I'm a renter in London. I work in London. I want to be near the office and where all my friends are, but I have thought about buying a house, further afield in outer London. Apologies, the whole legend is not appearing here. That's my error. But basically, each of these lines here are effectively, the black line's the average price of a flat in London in pounds sterling. And then we're comparing it to places like Luton in red, which you can commute to on the Thameslink line. We look at Uxbridge, which is the top line in purple there. We're looking at places like Dartford and Chelmsford. You can see there in 2016, there was quite a big gap between the prices of a flat in London and actually buying a house in a commuting distance from London. Now all these houses have sort of overtaken, particularly driven by the pandemic in recent years. And again, I'm looking at large areas here. If I was looking at the price of a house within walking distance of Chelmsford Station or Guildford Station, be much greater gap. And I think this is what's starting to drive people now back into flats in London. If we look further afield in the chart on the right-hand side there, you can see that if we start looking at houses in Birmingham or Brighton or Cambridge or Bournemouth, you can see that gap really starting to close there. So I think, this whole commuting, moving out of London commuting is becoming less of an option for people. And that supports my view that flats in London are going to get more interesting to people.
Richard, can I just ask a question? Because
Yeah.
someone's asked a question. Can you define the difference between inner and outer London? Because I think that's quite helpful for a lot of people watching.
Yeah, no, absolutely. So inner London is, it's local authorities. It's not prime inner London. It's not Belgravia, Knightsbridge, Mayfair, etc. It's from effectively Hammersmith and Fulham in the west, right the way across to Newham in the east, including all the city, Kensington, Chelsea. It includes Southwark, it includes Lambeth, it includes Islington to the north, it includes the City of London, Tower Hamlet. So it's that sort of whole you could commute to Oxford Circus on a tube within half an hour, basically.
Right.
And then outer London takes you out into Bromley and Croydon and Uxbridge and Heathrow. I mean, a bit of a longer commute, basically, into more into the suburbs of London.
But Canary Wharf would be counted as inner London.
Canary Wharf's inner London. Elephant and Castle will be inner London.
Okay, perfect.
Islington inner. Yeah, absolutely.
That's perfect. Sorry, I just wanted to ask that because
that's good.
Interesting. Good. Keep going. Thank you.
On the next slide. So look, the main message here is look. I say the relative value of a flat in London because its price has gone sideways. I just think we're going to see. I don't think prices are going to rocket for flats in inner London, but I think we're certainly going to see a lot more interest. And again, this is also linked through to the government really driving through house builders and the development industry, really sort of guaranteeing that issues around cladding, building safety are going to be resolved without huge expense to homeowners and flat owners. There were some concerns about leasehold costs, etc. So again, not all flats are new builds, not all flats are, lots of flats are different. So there's lots of opportunity, but you've got to choose the right properties. Next slide, please. And so I think, in terms of the outlook, I think inner London market activity is going to rebound as we see, employment growth, value for money. And again, London's a big place. There's lots of opportunities within London, and I'm sure we'll talk about that in the Q&A as we go through. Next slide, next element, please. I think rental growth is going to slow in London, but again, if you're buying property, just think about my rent's going to rise in line with earnings. You don't want to be putting today's rental growth numbers in of 12, 15, 16%. And assuming that's what you're going to see for the next 5 years. Rents track earnings over the long run. That's the real attraction of buying residential property. I do think rental growth is going to slow quite dramatically in inner London, but again, as long as it keeps growing, that doesn't matter. And I just think, look, London's had a number of setbacks since 2016. I think the housing market in London was absolutely red hot in 2014 and 2015. London prices had pushed way ahead of the rest of the country. Then we had the Brexit vote, which got businesses thinking twice about, investing in London. We saw some European nationals move out of London. We had a lot of tax changes in 2016. The London market was then about to take off in 2020 after the election. But then we had a global pandemic, which wasn't fantastic for global cities because it stopped travel, tourism, got people, again, all businesses around the world thinking about where they're investing and where they should invest. And now we've sort of almost taken the cork out of the bottle, and the government's trying to sort of fight for talent, get students returning here. We had record student numbers last year. The government had a target for 600,000 students a year by 2030. Last year we had 680,000 overseas students coming to the UK. So I think I just think London's just sort of reimagining itself is the way I would describe it. And it is a global city. It always will be a big global city. but it's about what this is going to be in this post-Brexit, post-pandemic world. And again, if we go back to the budget is designed to get that inward investment coming into the UK using some of the flexibility we have. And again, if we can grow jobs, if we can get the talent coming into the UK, you'll get the startups that ultimately drive that demand for London property, that drive rents along and support price inflation. So that's my quick summary, Mark.
Very good. No, I think it's very interesting. Thank you so much. That interesting you say that that you only think there's going to be 3 to 4% growth in rental prices. I mean, I think, you know, and the red hot market, the sales market was red hot, but I think the rental market, and I'm sure you'll agree, or maybe you won't agree, I think the rental market has kind of flagged the sales market. And I think only last year did we move into this super bullish red hot market where rents started to go up because there was such shortage of supply driven by lots of the factors you talked about. And I think we're going to see 6 to 7% growth this year in rental prices. But I mean, I don't know what you think it will be 2023, but I think that's where it'll be. Yeah,
and I think so. Look, and again, Mark, I think some of that growth might come in more value for money areas. I think that's the big challenge. But again, I think it's not about thinking about 1 year. You're investing, and I'm sure you'd say this to your clients, it's about taking a 5 to 10 year view. We just want really strong, sustainable rental growth, great cash flow. That's the joy of investing in property, basically. But no, I think, you know, some areas will definitely see 6 to 7, or maybe even more. I think other areas might slow a little bit more.
I agree. I think a lot of people, the only reason we look at what's it going to do in this year and then next year and stuff is because people like to forecast, and given the fact rentals didn't do very much for ages, people like to think, okay, so just quick, we'll finish off on some stats, but where do you think house prices are going to go over the next, 5 to 10 years? Because I mean, a lot of investors, they look at that. In the past, I'm sure, those of you that are old and seasoned know that it was always a long term. We used to say property prices, London property was a 5-year hold to 10-year hold. We're now saying that's definitely the case. You can't buy and flip. Coming in and out becomes increasingly difficult. I mean, so it's important to think that there is going to be growth over the next 5 to 10 years, as opposed to just yield, being reliant on yield. Where do you think prices going to be?
No, absolutely. I think there's two things. The sales, again, because the sales market in London has underperformed in the last few years. Actually, we're seeing activity levels almost in London doing a bit better than the rest of the country now, because there's such fast house price growth around the rest of the UK. It's almost got slightly extended in some areas. I think house price growth is, again, I think it's going to be around about the sort of 3 to 4% a year nominal. Probably it's not going to be huge amounts, but again, we've seen that for the last decade, that house price growth in the UK has just been within a sort of, it's still been going up in a tighter range, but not back to the good old days of 10, 20% house price inflation. So I think investors should be thinking 3, 4, 5% capital gains. Again, a lot depends where mortgage rates move in the next 5 years.
I mean, do you not? But you talk quite a lot about the difference, how flats have kind of underperformed houses in outer areas. Does that mean the 3 to 4% is a national thing, and you think we're going to see a bit more in flats, in like London? Because I think London has definitely underperformed the rest of the UK for the last 3 to 4 years.
It has. I think. Look, you could, again, it all depends what you buy and where you buy it. I think from a national average, it's 3 to 4. I said we could see a bit of an above average rebound in London flats. I think the thing is, rather boringly, Mark, it's all about who's buying them. And again, those incomes I showed, the income to buy a property, is not super cheap in London. So again, but I don't think people should be worried about that. I think more stability and just steady rental growth, steady house price growth, that's all an investor needs if you buy the right property. I just think it's, I think the days of double-digit house price growth are sort of behind us. Again, if you buy the right flat, you could see some sort of outperformance in the near term. But I just think, and again, if inflation's going to come back down to 2%, in a low inflation environment, decent real growth in both the rental side and the house price side is great.
Yeah, no, and I agree. I mean, look, we as a business advise a lot of clients. We have a lot of clients globally. And our aim is always to not try and buy something now that's going to leap in value. We want to do something that's going to be good and have very strong rental. It's in a good location. All the things I talk about, if anybody's listening to my stuff all the time, you know, near to transport, near to education, you know, outside space and in a good development. All of those things I think are really important. And I think the rental yields that we're seeing now, which is anywhere from prime, super prime, which is very low at 2%, going up to as high as 6% in the outer zones. And in fact, I didn't really want to do a sale thing, but we're doing a show in Hong Kong this coming weekend where we're working for Barratt, and we're offering something which I think it's never been in the market before. It's a 5% net yield. And as I said, I'm not selling it, and I'm not saying you should rush and buy it. The reason I'm mentioning it is it's showing that it's possible. The fact that we're doing it exclusively for Barratt and we've been able to put together this 5% net yield shows that. And after that, I think it will be a gross yield after that, because obviously we're going to start charging fees. But I think the gross yield will still be on these units 5.5 to 6%. So I think that kind of strong yield now that is possible if you go to zones further out, I think it's very interesting. But anyway, let's ask a good question that someone asked. Is buy-to-let still a viable asset class compared to stocks and shares? And what does a good return in the PRS, private rented sector, look like these days? Go on, Richard, that's your...
Well, it's sound like I'm repeating myself, but I think it's, look, I think it is a good investment. But again, I think we're seeing a shift, Mark, from, you know, back in the 2000s when house prices had a lot of room for growth because mortgage rates were tumbling. You know, you could get fantastic year-on-year returns because you take leverage, you get a lot of house price growth. You'd almost focus on the house price growth and the leverage more than the yield, effectively. Yeah. I think we're just shifting now into investors are focusing more on the cash flow, a bit more on, and so I think it still is it's still, you know, for me, and again, I'm a property expert, but I think residential property as part of a balanced portfolio is still there. But I think you've got to think of it more like a bond-like quality, delivering you that steady cash flow, and just take what the market gives you on house prices. And if you want to use leverage, use it, and that gives you a little bit more of a return on your equity. But say we are seeing this shift in motives. Investors have faced a lot of tax changes. Hopefully, we won't see any more. And again, the market's just coming to terms with those changes. So yes, I think it's but focus on the long term, focus on the rental growth. If you can 100%. Find a sort of an under-rented market or an area that's going to see really strong rental growth, that's going to really drive the value of your investment. I mean, I totally agree. I do think that you've got to put capital gains with the rental income, and I think it is a very, you know, let's be honest, London property is a world-class asset, and it is an asset class, and you are buying something that you can touch and hold. No one's going to take it from you. There is a shortage of supply. Richard didn't talk about the gross under supply of housing that is built, which is they predicted to be 50% this year of what we need. And I think that will drive capital prices, and I think it will continue to drive rental income. So I still think it's a good return, and it's a very nice, solid, stable. You should be getting anywhere from 6 to 9% a year when you take in capital with rental income. So I think, yeah, I still think it's a viable asset class. And the good thing for anybody out there to know is that, you know, if you're worried about where the market is, people are still buying for investment, you know, and we are still seeing it today. A lot of owner occupiers are buying, but we're still seeing investment. So I agree. Here's another good question. So the top 5 pitfalls of being a landlord. So what do you think? Have you got top 5? I've got 5. But you can do yours. I've got 3. Okay. 3. I think just. Again, we at Zoopla have a lettings advisory board and spend a lot of time chatting to letting agents. I think the taxation, the regulation changes just astounds me. And again, you haven't paid me to say this, but I'm amazed people there are half of landlords out there don't use an agent. I think it's kind of crazy. If you've got a property, you've got to use an agent. So I think it's people, one of the big pitfalls is trying to buy a property and let it and manage it yourself and then obviously, you know, don't let a sales agent sell you something without speaking to a letting agent, you know, because you just got to make sure that you're sort of those yields and the cost of managing and everything is correct. I think so trying to do it yourself, your number 1 is? Yeah, number two, it's hard in London to get lots of leverage, because especially if you're borrowing off a UK bank, the max loan to value you can get is probably sort of 50–60%. So that's a challenge because it is an equity intensive investment. But that's fine because it's all about what motivates you. And if you're focusing on the cash flow, you shouldn't be using huge amounts of leverage, and 50% is pretty decent. A third one is then this, we've talked about it, lower yields. You do get a low yield of sort of, as you say, anywhere between 2 and 6%. That's below cash savings today. Inflation's going to come down. You've got to hope interest rates will come down. And so you'd ideally like a higher yield, but you've made the point that you take lower yields plus house price growth. And look, again, exactly as you said, lack of supply, bond-like quality, really stable asset in a global city that has had some challenges in the last few years, but it's now starting to sort of pick up and move forward. So I think they're the big ones: is do it yourself. It's a bit, you need a bit more equity in London, and yields are a bit lower, but you've got to see the bigger picture, basically. But I say you've probably got, what are your 5, Mark?
No, so I think they're all good. Actually, none of them are the ones that I've got. I mean, I think just the finance one, the leverage thing is interesting because you can still get 75%. But I agree. The problem with that is if you can get it, then you end up having to top up the whole time. So even 10 years ago, when we were meeting investors, we were still then saying, don't borrow more than 65% because it covers the service. You want to have positive cash flow. And personally, I never borrow more than 65%. I try very hard to do 60 if I can because the rate is slightly better. But I think it's very important. But anyway, that by the by, my top 5s is one of the top pitfalls for landlords are voids, and voids kill an investment. And the reason I use that, the moment the market, as I keep talking about, is red hot. But if you are a landlord and you aren't guided by your agent and you simply guided by what's on the portals, and notwithstanding that Zoopla do a good job and the others do a good job, but you have to listen to what your agent is saying, where the market is. If you are looking for a tenant in December, it is not as busy as looking for a tenant in September. And so the rent in the very busy times will be higher. And if you demand too much, you may end up with a void. And so I think voids is a pitfall, but it can be managed by making sure your property is maintained well, looking after your tenants and looking after your property, and then making sure you're pricing it correctly, and you won't have a void. I think the second pitfall is buying a property that needs too much maintenance. And a lot of investors that we come across who've bought new builds, they have a view that that is more expensive than buying secondhand. Sometimes it can be, but be very careful with buying an old flat of what works. It needs upfront and ongoing maintenance, because high maintenance costs, if you've got an old boiler that needs replacing and wiring and all sorts of things that are coming in, which with around EPCs, that can really kill your returns. So that's the second pitfall and something you should look out for. Third thing is poor referencing. And I think poor tenant referencing, everybody thinks, when you meet them on the first day, they're the perfect tenant. But it is vital, and I say vital, that you check who these people are. As a business, we pay for it ourselves. We don't pass the cost on to landlords. We credit reference. We use an agency who does all sorts of checks on people. And you'd be amazed that we still today, I spoke to our referencing agency yesterday because I knew we were doing today. We still see one forged passport a week. One forged passport a week. So I say that you've got to check, who they are, because once they're in your 300, 500, £1 million in property, getting them out takes time. And so you don't want to have someone in there don't know. So referencing is the next pitfall. Fourth one, I think, is stamp duty. Now, you have to be careful with the amount of stamp duty that there's to be paid. And so therefore you need to make sure you do your figures, because stamp duty is a big effect. And it can affect the long-term investment. I think in the long term, it's not a problem because it gets washed through, 3, 5, 10% gets washed through over that time. But in the first instance, you need to bear in mind, because you're going to have to pay that in cash. So that's a pitfall people don't take into account. And the last one, I think, is not understanding the long game. And the reason I use that phrase is because a lot of people focus on the right now. I'm looking for this yield, or I'm looking for this capital growth. But you have to think owning a London property investment, or wherever you buy in the UK, is long term. So I think a long-term strategy is really important. And if you hold for long term, then you should do well. I don't know if you've got any to add to that, because one person asked a question here earlier and said, you know, I've owned for a long time. Should I just sell now because I own in a London property? Should I just exit? I mean, what do you think on that, Richard? If someone's owned an inner London property and we're talking about high yields outside, is it a good time? Is it a good time to sell?
That's a good question. Look, I think I totally agree with all the 5 you came up with, Mark. I think it's far more practical than mine, which are more market related. But I think, look, a few landlords have been selling up and taking gains for reinvestment or to pay down debt. Again, people got a bit spooked a year or so ago at the prospect of capital gains tax potentially going up, but that sort of has definitely been parked and has faded away. Although in the budget there were a few changes to the max capital gains. So it's all about, again, it's your point, is the higher yields enough in those outer London areas or higher yielding? And again, you're getting a higher yield because you're not going to get much capital growth. So, and on the basis that pretty much everywhere outside inner London has seen some pretty substantial house price growth in the last 3 years, if you were to cash up in inner London today to buy further afield, you'd be going to some pretty interesting markets that had great yields, but you've got a great yield because you're not going to get much house price growth. And so, again, I think it's potentially selling up, or to your point, we'll talk about in a minute, maybe about EPC changes and things, rationalizing today's portfolio to get it set up for the future could be a strategy where you might want to chat to your agent, dispose of 1 or 2 properties tactically, or get an agent to review your portfolio. They're the things to think about, really.
See, it's interesting. See, my view is and it's interesting. I get asked all the time. And as I said, when I started a long time ago, people used to, especially in Asia, a lot of our Hong Kong, Singaporean, Malaysian, Chinese clients would be buying a property, and then within 3 years, they're flipping it. They want to sell it, take a profit, and reinvest. Those were the days where there was no capital gains tax, stamp duty was low, it was easy to go in and out, finance was cheap as chips, and you could go in and out with very low costs. Today, the cost of exiting one market, selling one property and buying something else, whether it's in the same area or in a different area to get a high yield, you're losing about 10% of the value. I mean, that's what I generally say to people it costs you. With agency fees, clearly the sales agent's going to charge. You're going to have all the stamp duty, legal costs, furnishing costs, and renting it out costs. So my view is to shift from one area to another area, for me, is a mistake. And I would never, never, never advise that. It's different if you need the money. So if you own a flat in inner London and it's worth £1 million and you want to take £500,000 out and buy something smaller, 100% I get that, or you're giving the money to children. But I think if you're a landlord and you're in a market and you're in a thing that's generating a yield for you, I wouldn't sell it. I myself and my other directors at Benham and Reeves, we all invest in property and we almost never sell. Why? Because the yield you get, you've already paid those costs. That will be like you having a mortgage, a fixed rate mortgage for 25 years at 5%, and there's a 2% exit fee. And when the mortgage rate drops a little bit, you keep in and out, in and out. No one would do that. And I think property, you should be looking as a long-term hold. It should be, we advise clients, it's a wealth creation. So I think you buy a property, you pay the mortgage down if that's what you want to do. And if you want to look to, to improve your yield a little bit, rather than sell your property, if you own in Kensington, Chelsea or Westminster or a prime in a London area, why don't you refinance it? Because it is relatively easy to refinance, and then buy something else. That way you have more coverage, your yield will improve, and you're not losing so much money. That's just my take on it. So next question is, and a few people have asked all sorts of stuff about this. So question that someone asked, what government policies are due this year for landlords to be mindful of? So the first one is EPCs. So I think we should address that. Richard, do you want to do it, or do you want me to do it?
Well, you go for it, Mark. There's two for me. There's the renters reform bill, and then the whole EPC thing. So I'll let you start with EPC.
So I'll start the EPC thing. So EPCs, if anybody doesn't know it, it's called, you should know it if you're a landlord, it's called an Energy Performance Certificate. And an EPC was brought out several years ago, and it was to look at the energy rating of your property. And you started at A, which is the very top, and you have to literally be an insulated, like a Norwegian or a Swedish hut, which has such amazing insulation, all the way down to, it went all the way down to F and G, I think. And they slowly reduced it up. So you couldn't rent a property as the rating got at very low ratings. At the moment, the proposal is that this year, I think it may be delayed if we're lucky, you're not going to be able to rent a property. You can own it, but you cannot rent it if it's a D or below rating. Now, you can look at your EPC, and frankly, we as a business have started advising clients, and a lot of clients with the cost of living crisis haven't wanted to spend money at the moment. So we haven't been pushing it very hard, because we're hopeful the government are going to push it down the road and hopefully push it to 2024 or even 2025. But it is coming. And there are some very easy wins to improve your EPC rating. And you know, windows are important. Boiler is important. Insulation, if you have an old house, you know, how many houses don't have loft insulation and the heat just pours out? It's all about energy efficiencies. And at the moment, it's scheduled to come in this year. But as I said, I hope it's going to be kicked down the road. Richard, I don't know if you've heard anything, but I hope it is.
No, look, there's a lot of consternation in the industry and amongst renters, actually, about just this lack of supply of homes for rent. Not just this EPC change, there's all the other changes that have sort of hit the business plans or the returns of investors. And I think the government is conscious that if it's too aggressive with this move, which is the right thing for the long run, but it, you know, with higher rates and all the other things that are coming, you know, it's all about the timing of just how many more landlords with older properties, not just in London but elsewhere, might decide to sell and buy a better EPC property. And I think that could well happen. And I think, but again, you need to look at the cost. If it's going to cost you £10,000 to do the repair, to bring it up to a C standard, and it's going to cost you £50,000 to change property, then it's not worth it. Exactly. I mean, someone actually, sorry, I might have been wrong there. I might have misexplained. It's announced now, but it actually doesn't start till 2025 before anything. Yes. But we hope it's going to get kicked down the road after 2025. Someone did ask the question, are there any UK government established exemptions to the mandatory EPC? Absolutely not at the moment. There aren't any exemptions, but some may come. If you can only get your property up to a certain level because it's a stone barn in the middle of a field, then potentially there may be some exemptions, but don't count on it if you own a flat or a house in London. I really wouldn't want to start thinking about it. What's the next one you've got coming up? Well, the big one's renters reform bill. You know, the government pushing hard to effectively give renters almost more security of tenure. So the big one is there's removal of something called Section 21 no fault evictions. There's some limits as to how fast people can, you know, you can only increase the rent once a year on a tenancy. There's things around allowing people to have pets, not sort of excluding people with children and things. So there's a whole, I'm sure you've got a big list, Mark, but that's how do you see, that's quite a big one for people, isn't it? No, that is a very big one, actually. But Kate Faulkner, who's a very famous commentator on London property, actually kindly joined us today, and she just made a good point. She just sent me a message to say the government is saying that they've been advising government for ages. It can't possibly come in by 2025 for new lets. It can't be achieved, and they hope they're going to go back to 2028. Well, I hope Kate's right, but all I would say is just bear it in mind, watch what's coming, because when we had the problem with EICRs before, trying to get an electrician out to go and do that became incredibly expensive and became incredibly difficult to meet the deadline. So
look, just keep your eye out. As Benhams, we will inform people when it comes and let you know, but just be conscious. Have you got another, or are you?
That's it for me. They're my two, but I'm sure, have you got a longer list?
No, I don't. I mean, Section 21 abolition is the key one. So and EPCs is the main one. So there've been lots of other stuff that's come through. So actually, this is an interesting one. So you talked about inner London and outer London, and your graph showed how the London differential has dropped now, so it's better value to buy in London. So one person did ask, where's the best place to buy in London for investment? This is.
Well, I would buy, I think the whole of inner London's up for grabs, but I want to buy an new build flat, probably built in the last decade, with again, hopefully it's got a decent EPC rating of a B, at least a B, or hopefully an A, and it's got sensible service charges. I think that's, you know, again, anecdotally, I know some people that are literally in this position now, buying new build next towards a train station in a decent part of inner London, paying the same capital value today that the purchaser paid for the property in 2013. So that to me sounds like an absolute bit of a no-brainer, frankly. So it's sort of that, it's that sort of stuff. I think it's, again, you want to make, I totally agree with you as well, Mark, about buying old secondhand properties. I think people probably massively underestimate just, again, how much building regs have changed. Before you know it, you've got to rewire, replumb, new boiler, and then shared service charges. You know, at least with a new build, it's all there documented. You've got a track record. And again, obviously, you've got to check to see, you know, ideally low rise, you know, maybe up to 5 stories, so you don't get caught up in cladding and things and building safety. Yeah. So it's just choosing the right properties, great transport access. But I think that stuff is becoming a buy. I
agree. I think when they said the best place to buy, I think they wanted you to name a location. But I'll let you
I'll go sort of Fulham, Putney, sort of. I don't know. I go down into even Canada Water and places like that.
There though, that's the problem.
I know.
A lot of new build, and a lot of people do like, you know, one thing that we didn't talk about, pitfalls that people don't realize, is the buying process in the UK is slow, convoluted, and incredibly frustrating. So buying new build, sometimes it can be more expensive, but sometimes not. Is an easier process. So, but that's interesting. I tell you, when people ask me where the best places to buy, I always say to people, you know, because it's very hard, you know, there's loads of London, and London's a very diverse area. But I always say, look at where Benhams are opening offices, because that gives you a clue to where, you know, we think local markets are set to be most buoyant. You know, we're, as a business, we're estate agents, so we look at areas. So where are we opening? Well, I've just got a new office about to open in the Wembley area, because that has been a huge growth area. You know, you've got the stadium with the 1,500 homes built around it. There's a lot going on in that area, some new build, and actually it was pretty unloved for a very long time. And actually, I think it's very convenient and is an area. The other place we have an office, which a lot of our clients will be slightly surprised that we're going to open, is going to be in Southall. And that's near the airport. It's at a development called the Green Quarter that being built by, it's a massive regeneration area. And why did we choose there? Because there is a lot coming. And again, it was an unloved area. And I think that regeneration that goes, you know, we were talking about things, why you buy things, is regeneration, I think, is one of the key things that helps kick you up the road and get you a bit extra capital gain. And I you know, personally, I bought in the Green Quarter, which is in Southall, because I believe in that area, and we're opening an office as well. But I just think these kind of slightly unusual niches are interesting to buy. But as Richard said, he chose Fulham and Putney because they're good established areas. And I think it's interesting to see, as you say, with capital prices staying low and yields increasing, they become these older, you know, traditional prime, if you like, prime areas are doing very well now. And it is interesting. Canary Wharf as well, as I think Canary Wharf is going to have a bit of a boom this year. Huge number of people back in the office working in Canary Wharf, dire shortage of accommodation for rental. And actually prices there have again been quite flat for the last 3 to 4 years. So actually, I think Canary Wharf will do well.
And you probably
Okay,
got to look at the, again, you probably should caveat it with, I mean, look for a 10-year-old property, but even then, you know, you've got to check out what you can get for new build, for brand new spec. You know, it's sort of
100%.
it's that's the 10-year-old might look good today, but again, to your point about, do you have to spend a bit more money on it in the next 10 years than buying brand new today and hopefully getting a decent deal?
Yeah, I agree. You can get deals. You can definitely get deals at the moment. Someone just asked a question because I was going to move on to my last question. I know we're coming up to 11 o'clock. We're going to slightly run over because I've got one really good question, which I think I'll ask at the end. Is someone just said, is if now is buy and hold for 10 years for investors, the buy to let with interest payment without principal payment, i.e. you're paying down the capital as well as interest, it's no longer attractive. I don't think that's the case, Richard. Do you?
No, not really. Well, it's not attractive if you only want to invest if you can do 75% loan to value leverage and take full leverage. I think this is the shift we're seeing from look, that did work. If you think attractive is when house prices are rising 10 to 20% a year, and you can do 75% loan to value. I mean, that's, as you said, that's a bit of a no-brainer, but that's, you know, that can't last forever. So in a lower inflation, I know we've had a spike in inflation, lower interest rate world, if you can get sort of say 4 to 6% yield and you can get 3 to 5% house price growth over 10, 15 years, and you can do 50% leverage, I think a lot of people quite like that, basically.
I think so. Yeah. I look, you know, everybody wants to pay down the loan, but the reality is you've got to look at what your investment is. If you're buying a property for £400,000 and you're borrowing 50%, so you're putting in £200,000, by being able to pay the loan down is a return in itself. So actually, I don't see that. And I still think it's good long-term growth for all the reasons we've talked about. So I don't think you should look because interest rates have moved up, which they have. But let's be honest. I mean, that was my last question that actually someone else asked before. You know, do we think fixed rate mortgages will fall further? Let's address that, because I think that ties into a lot of things.
Yeah, no, you're right. Look, you know, just over a year ago, you know, mortgage rates for new buyers were about 2%. It's well known in the headlines that mortgage rates reached about 6% at the end of last year after the kind of crazy mini budget. Rates have fallen back. So I think 5-year fixes for new home buyers are around about 4%, 4.5%.
HSBC has a sub 4% loan rate
for a remortgage. Yeah, so I think you know, really competitive remortgage is going to be about 4. I think for, you know, 4.5 is probably where the market's going to be this year. You know, inflation seems to be a little bit sticky. Some of these wobbles in the banking industry mean that, you know, central banks might not push rates up, but I think if you can get 4 to 4.5% finance over the course of this year, that's manageable. And again, we've got to remember, it's a very boring technical point that basically for the last 5 years, anyone taking a mortgage has had to prove to their bank they can afford 6 to 7%. And so a lot of it's about what banks. So banks are now back to checking whether we can afford 6 or 7, and we're paying 4.5. Now, of course, we've got the pain of we used to pay 2% and now we're paying 4.5. But again, compared to rent, it's lower in many parts of the UK. So I just think, yeah, I don't think, unfortunately, rates are probably not, unless we see a real drop in interest rates and the interest rate outlook, I just don't think we're going to go below 4% probably for the next year or so, maybe a little bit longer. So, and if you can make it work at 4.5, then go for it, basically.
I agree. I think that, you know, in my opinion, I think they will fall further. I think we're already seeing what came out from the budget yesterday, which there wasn't much to talk about, but the budget was talking about, you know, seeing forecast inflation to come off now quite considerably, because what everybody doesn't bear, I think what people misunderstand on inflation, or maybe just for people like myself, is they think inflation is about where prices are. Inflation is about where prices are going or where they've moved to, i.e. so the fact that petrol prices in the UK have come off now, and, you know, the cost of living has already gone up with foods and all of that. Therefore, I think we should see inflation come down quite considerably. And if it does, I think there'll be more downward pressure on rates. And I think the government, you know, let's be honest, in case you hadn't realized, our government, I don't know if you do or don't know, governments in the UK only stay in power for 5 years. and we will have a general election next year because that's the 5-year period. And they're going to need some good news stories in the run up to it. And there's predictions that we may have a Labour government. So bearing that in mind, I think you're going to see the government wanting to see some really good stories, good news stories, and trying to put some money into people's pockets to make them feel better. And a way to do that is to put downward pressure on interest rates. And, let's see. I mean, the budget, the only thing they did in the budget was to help people they've removed the lifetime allowance on pensions. So that has, is good for older people continuing to work and stuff. But, I think we will see some, I hope that we will see some other stuff. So last quick question. Do you think if a Labour government gets in, because it has been asked by a few people now, do you think if a Labour government get in, they will really bring in rent controls and it will really be bad for an investor?
Good question. I think that both political parties need a clearer strategy for the lettings market and the rental market. The availability of homes to rent is key for economic growth, basically. And I think so we shouldn't really have any policies that lead to any big disinvestment of landlords. And so hence the debate about EPC certificates, the timing of that, etc. I think, again, there's different types of rent controls. Often bring a lot of us older folk to think about post-war, when rent controls set rents at about 10% of the market value, which is not what people often talk about. I think people talk about something called rent stabilization, which is you rent a property at the open market rent, and then it's limited how fast it can go up over the tenancy in line with earnings or inflation, which again, long-term investor shouldn't have a problem with. So, but generally speaking, around the world, rent control does have adverse consequences, basically. And I think it distorts what's already a distorted, undersupplied market. So I just don't think, I'd far rather we had any government coming in of any political complexion just really focusing on boosting supply and making sure we've got a decent supply of rented homes 100%. And that there's a decent market to operate for big corporates, as well as landlords and their agents that want to deliver good quality rented housing for much needed renters, basically.
I think it's quite interesting, actually, and I think it ties into the whole abolition of Section 21 and the Renters Reform Bill and all of that, which I know is under a Conservative government. The abolition of Section 21, I think it is an issue, but it's only an issue if you're not a long-term landlord. If you're a long-term landlord, the abolition of Section 21 will not stop you evicting the tenant or getting the tenant to go in order to sell your property. Or if you want to move back in yourself. These are valid reasons where you will get, they promise, quick access to evict the tenant and to get your property back. Relatively quick access. It's not going to be in a week, but it will be, 2-3 months. Which is not unreasonable. So if you want to sell, i.e. exit and recoup your money, you'll be able to. If you want to move back in, or your son or child wants to move back in, you'll be able to. Having a control on rents, as you say, rent stabilization, I don't think it's terrible, because it means that, they will be fair. It's not going to be set on very low sub-inflation increases. It's going to be, hopefully, based on where the rental market is, and it doesn't see these big spikes. But of course, all of us would prefer to be without it. But in the longer term, I don't see it as a bad, as a bad thing that you should be frightened of, and certainly put you off investing, because the key thing which Richard said is the gross undersupply of housing. And even with the corporates coming in and building build to rent, that is supply, but it's still not enough. And the other thing to bear in mind is, a lot of investors say to me, well, Mark, I'm worried that I'm just like one little fish with all these huge corporate investors coming in. Actually, it's all those little fish that run the market. Private landlords are far more nimble and are far more tenant focused than large corporates are. So you can adjust your rent quickly. You can get a relationship with your tenant, a good relationship, so they'll stay and you can work with them. A big corporate, it's all a spreadsheet. So it's it's a much different type of market that you have as a private landlord. And so therefore, I think private landlords are going to stay and will continue. And you, as I said at the beginning, we are still seeing private landlords coming in and buying because it's still a good global asset. It still gives you a good return. And I think it's still, it's a safe and good long-term hold. But I think we've done over an hour, which I promised and we would try to stick to. So I think that's the end for today. I'm sorry we didn't give much of an update on the budget because there really was zero that was property related, except, as Richard said, the investment into, you know, into leveling up, into the economy, which we see, which drives the ability of people to be able to afford rents. And continue to drive the London market. I think the only thing I didn't talk about, that we didn't talk about, and the last thing I will mention is the tech sector, which gets left out an awful lot. Is we have such a strong tech sector in the UK, and that's going to continue to grow in London especially, and that will continue to drive demand for housing, both for rental and from a sale perspective. So is there anything else to add, Richard, or are we done?
No, I think we covered it. It's been an enjoyable discussion. I think there's a lot. The thing is, you know, London is a large, diverse, multi-segmented market. So there's something for all types of investors, I think, is the main message. And I think it's a market that is probably going to do a little bit better than people might expect in the next 2 or 3 years.
Yep, perfect. Well, thank you very much for everybody for joining. I know a lot of people came and said they're leaving. Are we going to get a recording of this? Yes, you are. It will be sent out afterwards. And if you have any questions, by all means, come to me. I can pass them on to Richard if they are data related, because he's the expert. And thank you very much for joining us today, wherever you are. Thank you.